Good afternoon. Thank you for joining the webinar today on the importance of fixed income. I hope that every one of you can hear me. Okay, my name is Christine. I'm the relationship manager based in North Point City branch. And today I'll be sharing with you on the importance of fixed income. Okay, a little bit about Philip before we start. We have established in Singapore since 18 June 1975. And since its inception as a stockbroker, Philip Capital has grown into an integrated Asian financial house with a global presence that offers a full range of quality and innovative services to retail and high net worth individuals, family offices, as well as corporate and institutional customer. And information technology and distribution are our core competencies in the provisions of financial services. And these are our corporate profile. We have assets under management, total of more than USD 50 billion worldwide. Our shareholder funds in excess of USD 2.5 billion. And we have over 1.5 million clients worldwide and over 5,000 employees worldwide as well. And a little bit about our founder's profile over here. Mr. Lim Hua Min is the founder and executive chairman of Philip Capital and its subsidiaries, as well as the chairman of IFS Capital Limited in Singapore. He previously served as a board member with IRAS and on a number of committees and subcommittees of the Stocks Exchange of Singapore. And in 1997, he was appointed chairman of the Stocks Exchange of Singapore Review Committee, responsible for giving recommendation to make Singapore capital market more globalized, competitive, and robust to compete internationally. And as you can see below, these are the acknowledgements and achievements of our Mr. Lim. Okay, I'll go to the next slides. And we have our growing global presence in 15 countries. Yes, okay, so basically for Philip Capital, we are actually first to introduce online trading, which is POEMS in 1996. And in 2001, we are the first to launch SPP, which is the Share Builder Plan, a regular savings plan for shares purchase. And in 2003, we bring CFD to Singapore as well. And up to 2022, we have actually launched POEMS Mobile 3.0. And these are the products and services that we currently hold in Philip. Of course, other than stocks, we have wealth management, we have unit trust, we have regular savings plan, we have CFD, we have insurance and money market fund, as well as the others that you can see over here. Right, so let's dive straight into today's topic. What is bonds? Before we go further into different investment strategies with bond, let's learn a little bit more about bonds first and what exactly is bond. A bond can be seen as a loan taken out by a company, but instead of taking a loan from the bank, the company takes the loan from investors who buys the bond. The bond is first originated and then purchased by an investor, after which it is a coupon paying bond. The company will then make coupon payment to the investors until maturity before the company will repay the principal loan amount in exchange for the capital. As you can see over here, number one, the bond origination. Number two, bond is purchased by an investors. The investor will then receive a coupon payment to them semi-annually or annually. And when the bond matures, the company repays them the principal. And over here, these are the features of the bond. Each bond issue is different, and hence it is important to understand the precise term before investing. In particular, there are 6 important features to look for when considering whether to invest into a bond. So the first one will be the maturity of the bond. This is the date when the principal or par amount of the bond is paid to investors and the company's bonds obligation ends. Therefore, it defines the lifetime of the bond. A bond's maturity is one of the primary consideration an investor weighs before their investment goals and horizon. Maturity is often classified in 3 ways, which is short term. For short term, bonds that falls into this category tends to mature within 1 to 3 years. For medium term, maturity dates for these types of bonds are normally over 10 years. And lastly, for long-term bonds, these bonds generally matures over a longer period of time, which is more than 10 years. The second one will be a bond can be secured or unsecured. A secured bond pledge specific assets to bondholders if the company cannot repay the obligation. And this asset is also called collateral on the loans. So if the bond issuer defaults, the asset is then transferred to an investor. A mortgage-backed security is one type of secured bonds backed by titles to the homes of the borrower. And for unsecured bonds, on the other hand, are not backed by any collateral. That means that the interest and principal are only guaranteed by the issuing company. Also called debentures, this bond returns little of an investment if the company fails. And as such, they are much riskier than a secured bonds. And the third one over here would be the liquidation feature of a bond. When a firm goes bankrupt, it repays investors in a particular order. After a firm actually sells off its assets, it begins to pay out its investor. Senior debt is a debt that must be paid first, followed by junior subordinated debts, and get whatever is left. The fourth one over here will be the coupon. The coupon amounts represent interest to bondholders, normally annually or semi-annually. The coupon is also called the coupon rate or nominal yield. To calculate the coupon rate, divide the annual payments by the face value of the bond. And the fifth one over here will be tax status. While the majority of corporate bonds are taxable investment, some governments and municipal bonds are tax exempted. So income and capital gains are not subject to taxation. Tax exempt bonds normally have lower interest than equivalent taxable bonds, and an investor must calculate the tax equivalent yield to compare the return with the taxable instrument. And lastly, callability. Some bonds can be paid off by an issuer before maturity. If a bond has a call provision, it may be paid off at earlier dates at the options of the company, usually at a slight premium to par. And a company may choose to call its bond if interest rates allows them to borrow at a better rate. Callable bonds are also appeals to investors as they offer better coupon rates as well. Okay, now that we know the different feature of bonds, what are the pros and cons of investing in bonds? And as you can see over here, the advantages on the left side, it receives income through coupon payments, which is the interest, and hold the bonds till maturity and receive back your principal sum amount. You can profit if you resell the bond at a higher price. And predictability will be you are informed on how much interest you will receive and how often as well. And attractive, basically interest rate paid usually exceeds that of a bank interest. But the disadvantages over here will be bonds pay out lower returns than stocks. Companies can default on your bonds, and of course, bond yields can fall as well. So apart from the advantages and disadvantages of investing in bonds, it is also important that we are familiar with the different risks associated with bonds so that we only make investment decisions comfortable for our risk appetite. So the first one over here will be, the first risk associated is called as interest rate risk. Interest rate shares an inverse relationship with bonds. So when rates rise, bonds tend to fall and vice versa. So interest rate risk comes when rates change significantly from what the investors expected. So if interest rate rise, the investor will be stuck with an instrument yielding below market rates. And if interest rate declines significantly, the investor faces the possibility of prepayment of the bond. Prepayment is a scenario where the company repays its principal amount to the investor earlier than the maturity date. The greater the time to maturity, the greater the interest rate risk to an investor bears, because it is harder to predict market development further into the future. The next risk to consider will be the credit or default risk. This is the risk that interest and principal payment due on the obligations will not be made as required. When an investor buy a bond, they expect that the issuer will make good on the interest and principal payment, just like any other creditors. So when an investor looks into corporate bonds, they should weigh out the possibility that the company may default on the debts. Safety usually means that the company has greater operating income and cash flow compared to its debts. If the inverse is true and the debt outweighs available cash, the investor may want to stay away. And lastly, which is the prepayment risk. This is the risk that a given bond issue will be paid off earlier than expected, normally through a call provision. This can be bad news for investors because the company only has incentive to repay the obligation early when interest rates have declined substantially. And instead of continuing to hold a high interest investment, investors are left to reinvest funds in a lower interest rate environment. So that we have covered the risks involved, let's compare bonds and stocks. So for bonds, are issues of debts that is made with an investors for cash in exchange for payout of interest, and typically traded over the counter. For bonds, generally lower risk, lower rewards, can be made as corporate, municipal, or treasury bonds. But for stocks over here, issues of a stake of ownership in a company, a claim to a company's assets and earnings that often gives the investor voting rights and also pay dividends, and typically traded over through the central exchange, generally higher risk but also higher rewards, and issued by companies at the stocks exchange as IPOs. And in our opinion, our investment portfolio should not only contain either bonds or either stocks as well. In fact, these two asset classes can come hand in hand, and buying bond can serve as a good diversification of your portfolio. Here are the main 5 types of bonds, and we go to the first one, which is angel bonds. Angel bonds are investment grade bonds that have credit ratings ranging from BBB minus to AAA, and normally offers a lower interest rate. So if the bond issuer's ability to pay the bond's principal is reduced, the credit rating may fall below investment grade's minimum and become a fallen angel. Next one over here will be callable bonds. These are bonds that we can redeem by the issuer prior to the maturity date. This could occur if interest rates are declining, and if interest rates have declined since the companies issued the bond, they may wish to refinance the debt at a lower rate. In this case, the company might call its current bond and reissue a new one, lower interest rate bonds. Next one, bonds that are issued by corporations, also known as corporate bonds. Generally, a short-term corporate bonds has a maturity of less than 3 years. Intermediate is about 3 to 10 years, and long-term more than 10 years and above. So corporate bonds, however, have a minimum investment amount, which is 250,000. But in a while, we will go through what are the other strategies that we can use to still gain exposure to the bonds should we not have such a big starting capital of the 250,000. The fourth type of bond, also known as junk bonds, are bonds with credit rating below double B, double B plus. Because of their high default risk, as its name suggests, high yield bonds typically offer interest rates higher than investment grade bonds. And lastly, perpetual bonds are bonds that have no maturity dates. In most circumstances, they will have a call date instead. So now that we have a better understanding of what bonds are and how it works, here are some ways that you can invest in bonds. So we will proceed to the next slides over here. So the first one will be investing in MAS government bonds. You can actually buy SGS bonds and T-bills using your cash, your SRS, or even your CPF. And the minimum investment amount for SGS bonds and also T-bills is 1,000. So what are the application method will be for cash application? You can actually get it through your respective partner bank, which is either DBS, BOSB, OCBC, or UOB ATM. For SRS application, will be the internet banking portal of your SRS operator, again, which is DBS, BOSB, OCBC, or UOB. And lastly, for CPF application, you will need to submit an application in person at the main branch of your respective CPF investment bank. As an example of investing in corporate bonds, which is the minimum of 250,000. So as you can see over here, the bonds under this will have a maturity between 2024 to 2026, which is in about 2 to 3 years time. So these are example of the bonds which for the coupon payout and also the ask price. And the bonds over here has the maturity date and the yield to maturity over here. One over here we can see will be bonds that will be maturing in 2027 or to 2029. And lastly, these are the bonds that will be maturing on 2030 onwards. Okay, other than that, we also have Bond 50. So to make bonds more accessible to investor, our bond desk at Phillip Capital is actually proud to launch our new Bond 50 product line. Bond 50 are a wholesale bond traded in a lot sizes of 50,000 instead of the usual 250,000. And it actually helps to free up your cash in your portfolio instead of locking in the $250,000 per bond. So this allows you to have a greater number of bonds in your portfolio and makes building a diversified bond portfolio much easier and possible. And to trade in our new Bond 50, you will first have to declare as a AI, which is accredited investor, which has the criteria of a minimum 2 million in assets or 1 million in financial assets or at least 300,000 in annual income. So if you'd like to know more about how to opt in to be an accredited investor, do contact us. Over here, we'll be investing in unit trust, which with bond exposure. So to invest in unit trust, the minimum initial investments will be 1,000. Subsequently, will be $100. So these are example of the unit trust bond exposure funds that is available. So to know more about what are the unit trusts that which has exposure in bonds, you can actually go to our website at Poems and you can click to unit trust and go under fund finder. So over here, you can see at the asset class over here, you can choose like what are the assets class that you are looking for example, fixed income. So these are example of a fact sheet for unit trust. So you can see on the key facts on the right side over here, right? The assets class will be fixed income, which will be more in the exposure in the bond market. So to trade bond in Poems, first thing first is no commissions, no processing fees, no platform fees. competitive spread as well. We have access to more than 70 counterparties and 9 different currencies, and participation in both primary and secondary bond market globally. So you are able to choose from over 200,000 bonds worldwide via our bond finder on our Poems website as well. So I have come to the end of my fixed income presentation. Again, my name is Christine. I'm from Phillip Investor Center, North Point branch. I will, is there any questions from the audience? Any questions about the bonds that you would like to know more? Okay, to reply to Chai Hin Ang, the unit trust and bonds are taxable. No, it is not taxable. You can actually go to our website, and if you would like to know more about unit trust that is focused in bonds market, just go to our Poems website, click under unit trust, click under fund finder, and we have many different fund houses that we are partnering with. So you can click on the fund houses and choose the types of assets that you are looking for. Okay, for jamming, right, how to buy bond 50? First thing first, before you buy bond 50, right, you need to actually be an accredited investor first. And then there are available bonds that you can choose from in our Poems online as well. So to find out more about bonds 50, hold on now. Okay, so I believe that all of you can see from my screen sharing here. To know what are the available bond 50, you can just go to Google and type in Poems bond 50. You'll be over here on our screen over here. You can see under bonds offered for bond 50. And these are the available bonds that you can buy with minimally 50,000. And if you'd like to know on how to be an accredited investor, it's actually very, you just need to log into your Poems through web browser to be an accredited investor. Go to account management, go to online forms. So once you are there, you go over to the third box, which is the trade assessments and acknowledgement. Click to accredited investor. So once you are in this site, you can choose on which options that you would like to declare. The first one will be net personal assets. The second one will be financial assets. And third one will be to declare of your annual income over here. Okay, any other questions from the audience? Don't feel free to give me a call if you have any other questions in regards to bonds. And also what are the bonds that is available in our Poems online. So if there's no any further question, that will be all for today. Thank you everyone for joining my webinar. Have a great day ahead. Thank you.